Every day, trillions of dollars travel around the world at the speed of light. No passports, no borders, no lines. And yet, most countries never get rich. They stay right where they are. This isn't an accident, and it's not because they're bad with money, because global money doesn't move the way you think. And once you see how it actually moves, you can't ignore it. Right now matters, because global money flows are changing faster than governments, voters, or even markets can comprehend. Interest rates have risen. Debt has ballooned. Capital is panicked. And when money panics, it doesn't expand. It flees towards safety, towards power, towards places where it already exists. Let's start simply. Think of the world as a large neighborhood. Some houses are large, stable, well-lit, strong doors, good locks. Other houses are smaller. Some are still being built. Some have cracks. Now think of money like water. When water flows, it doesn't see the right thing. It looks for the deepest, safest container. That's global money. Money doesn't flow where it's most needed. It flows where it feels safest. And safe has a very specific meaning. Not morality, not potential for growth, not human need. Security means, can I get my money back? Can I get it back fast? Can I get it in a currency everyone accepts? This is where the story really begins. Most global money doesn't come from factories, trade, or hard work. It comes from financial capital, pension funds, insurance companies, sovereign wealth funds, big asset managers. They control tens of trillions of dollars, and they have one job: don't lose it. They move money across borders constantly, buying bonds, selling currencies, parking cash, pulling it out. This movement is called capital flows. It sounds neutral, almost boring, but it decides which countries grow and which ones stall. Here's the uncomfortable part. When money enters a country, it doesn't automatically build schools or factories. It often does something much simpler. It buys existing assets, government bonds, real estate, stocks. Prices go up. Locals feel richer. Governments feel confident. Then something changes. A rate hike in the US, a crisis somewhere else, a rumor, and the money leaves fast, faster than any real economy can adjust. That's the core imbalance. Global money moves in seconds. Countries move in years. Let's talk about the dollar, because everything leads back to the dollar. Roughly 60% of global reserves are held in dollars. Most global trade is priced in dollars. Most international debt is borrowed in dollars. Even between two non-US countries. This means something subtle but brutal. Countries don't just manage their own economies, they manage their exposure to US money conditions. When the US raises interest rates, money gets pulled back toward dollar assets. US bonds suddenly pay more, and they're considered the safest thing on earth. So, capital flows back. Emerging markets feel this immediately. Their currencies weaken. Debt becomes more expensive. Inflation rises. They didn't change their policies. They didn't vote for this, but they pay for it. This isn't a conspiracy. It's plumbing. Global finance plumbing. Now let's zoom into a real pattern. A developing country opens its markets. Foreign investors arrive. Capital flows in. The currency strengthens. Imports get cheaper. The government borrows more. Everything looks good. Then, global conditions tighten. Money leaves. The currency crashes. Debt payments explode. The government cuts spending. Growth reverses. This cycle has happened dozens of times. Latin America in the 1980s, Asia in the late 1990s, Eastern Europe, Africa, repeatedly. Each time, the story is told differently, but the mechanics are the same. Here's the hidden mechanism most people miss. Debt is global. Income is local. Countries borrow in global currencies, but earn in local ones. If your currency falls 20%, your debt doesn't shrink, it grows. That's how countries get trapped, not because they borrowed, but because they borrowed in a system they don't control. And here's the irony. The countries that issue global currencies get to borrow endlessly. The US runs massive deficits year after year. Japan's debt is over 250% of GDP. No panic. Because they borrow in their own currency, and the world needs that currency. That's power, not military power, monetary power. Now contrast that with hype. You've heard the story. Globalization lifts all boats. Foreign investment drives development. Capital will flow to opportunity.
Sometimes it does, but more often it flows to stability, which means already rich countries get cheaper financing, stronger currencies, and more control. Poorer countries get volatility, and volatility kills long-term planning. You can't build factories if your currency might collapse. You can't fund schools if debt payments double overnight. So governments become cautious or desperate. They cut spending when people need it most. They raise rates to defend currencies. They slow growth to survive. This is how staying poor isn't a failure. It's a position in the system. Now let's zoom out. Global money doesn't just move unevenly, it concentrates. The top financial centers absorb most of it. New York, London, Frankfurt, Tokyo. Money circulates there. Assets inflate there. Power accumulates there. And because financial returns compound, the gap widens. This isn't about laziness or corruption as the main explanation. Those exist, but they're not the core explanation. The core explanation is structural. The global system rewards currency issuers and punishes currency users. It rewards those who can print what everyone else needs. Now here's the quiet humor in all of this. Countries are told to be responsible, balance budgets, control inflation, open markets. But the countries writing these rules don't follow them. They don't need to. They export risk. When the things go wrong, money runs home. And when crises hit poorer countries, they're told to tighten belts. During global crises, capital floods into U.S. assets, even when the crisis started there. That's not logic, that's powerarchy. So what does this mean going forward? Debt levels are higher than ever. Rates are volatile. Geopolitical risk is rising. Global money is becoming more cautious, not more generous, which means capital will concentrate even more unless something changes. Either the system fragments, or more countries try to escape dollar dependence, or crises force restructuring. None of those are smooth, and none guarantee fairness. So here's the unresolved question. If global money will always chase safety, and safety is defined by power, and power is reinforced by money, how does a country ever break out? Not rhetorically, mechanically. That question doesn't have a clean answer, but it explains a lot. Why growth stalls, why inequality persists between nations, why global money keeps moving, and most countries stay exactly where they are.